Hey traders, and welcome back to another episode of Trade Like Assad. Ever asked yourself why price revisits the same candle before making its actual move? That candle isn't by chance, it's more than just structure, it's a mitigation block. One of my go-to entry techniques for pinpointing precise trades in the market. These are the stealthy zones where big players quietly fix their imbalances, gear up, and push the trend forward like nothing changed. In today's video, we're going all in on mitigation blocks from start to finish. What they truly represent, how smart money leverages them to steer price, how to spot them before they catch you off guard, and most importantly, how to trade them for high probability entries. I'll also break down the exact rules and filters that distinguish a regular candle from a legit institutional level mitigation block. We're always thankful for your support, so drop a like on this video, and if you're new here, don't forget to subscribe. See you after the intro. Welcome back traders, so let's jump right in. First up, what exactly is a mitigation block? A mitigation block refers to a price zone where institutional players pull price back to offset or neutralize losses from earlier failed positions. At the same time, they enter or scale into new trades in the direction of the prevailing trend. More critically, it becomes a vital decision zone where institutions recover earlier drawdowns and secure more favorable entries before driving the trend forward. To put it simply, it's where smart money tidies up the past mistakes and turns them into momentum for the next major move. Now let's dive into the psychology behind it. Institutions aren't guaranteed flawless entries. Sometimes they enter prematurely and face drawdown in the market. When you're trading millions, even a 20-pip drawdown becomes significant. So what's their response? They drive price back into the mitigation block to exit or minimize earlier losing trades, tighten entries with increased volume, and initiate fresh positions to stay in sync with the trend while trapping emotional traders who confuse the move for a full-blown reversal. And here's the twist. This entire shift appears like a typical pullback, but in reality, it's a calculated move disguised as a retracement. Wait, does that mean mitigation blocks are only used to fix bad entries? Not exactly. In smart money terms, mitigation also refers to revisiting a zone where previous orders were only partially executed or where price moved too rapidly for full entry executions. So even if they're already in profit, they might still pull price back, just to finish filling those positions. Wait, isn't that just another order block? No, here's the crucial distinction. Order blocks mark where institutions initially enter trades, usually at the start of a trend. They're decisional zones formed before institutional orders are fully placed. Mitigation blocks, on the other hand, are revisited zones, where institutions come back later to finalize incomplete entries, adjust earlier positions, or sharpen entries after price has already moved. So think of the order block as the initial push, and the mitigation block as the smart money's return trip, the cleanup operation. That means a mitigation block is reactive, not the starting point. It's the zone where institutions fix poor entries or scale in with added volume, not the place where the trend was first created. Let's make this crystal clear so you can visualize how it plays out. Picture the market in an uptrend, printing higher highs, then smart money starts setting up for a reversal. They begin accumulating short positions quietly. To build enough liquidity for massive shorts, smart money creates a deceptive move downward. This move clears previous lows, tricks traders into thinking the uptrend is finished, and pulls retail traders into selling. Then price snaps upward aggressively, stopping out early shorts. This surge gives the illusion that the uptrend is resuming. Right after this manipulation, smart money initiates a real drop, causing a shift in market structure. Price then revisits the mitigation block, not to recover drawdown, but to complete unfilled institutional entries and to trap late buyers. From that point, price moves down sharply in the genuine move. In this scenario, smart money didn't lose on the first attempt. They used the fake drop to gather liquidity, then revisited the mitigation zone to complete their positions and power the real displacement. So yes, mitigating drawdown can be involved, but the main purpose isn't fixing losses, it's ensuring full order execution within engineered liquidity zones. Before we dive deeper, let's break down how to recognize a valid mitigation block. From the perspective of candlestick structure. From the candlestick perspective, a mitigation block refers to the final candle or cluster of candles moving against the trend that sets up the fake move and the displacement leg. So what does that mean? A bearish mitigation block forms during a clear uptrend when price creates a swing high, then a swing low, and then a lower high before breaking structure with a strong bearish displacement that closes beneath the previous low. Your valid mitigation block is the down close candle or group of down close candles that occur between the initial high and the first low. In this example, it's the 2 consecutive down close candles. We mark the zone from the wick of the first candle to the upper wick of the second. To trade this setup, you'd place a limit order at the bottom edge of that mitigation block, so once price retraces back into that zone, your order would be triggered and the market would likely move lower. This is how a bearish mitigation block can be used to position for a short entry. A bullish mitigation block works in complete contrast. For a bullish mitigation block, we look for a clear downtrend. A swing low, followed by a swing high, then a higher low, before price shifts structure with a bullish displacement leg that closes above the recent swing high. The bullish mitigation zone is made up of the up close candle or a set of up close candles formed between the first low and the first high. Once again, we outline that zone from wick to wick. To trade a bullish mitigation block, you'd set a limit order at the top boundary of that zone and wait for price to return and trigger your entry. So now let's explore the core rules and criteria that allow us to spot valid, high probability mitigation blocks, especially the ones that offer the strongest trade setups. Rule number 1: focus on finding mitigation blocks within higher time frame points of interest. The most reliable mitigation blocks aren't just floating in the middle of a chart, they usually appear inside or right after touching key zones on the higher time frame, such as an IFC candle, a supply or demand zone, or following a liquidity grab near a major swing point. These mitigation blocks have institutional relevance. Why? Because institutional players are already active at those levels, they're watching those areas closely, planning entries, exits, and risk management. That's why any mitigation block that forms within those zones becomes significantly stronger when price comes back to that block. Backed by higher time frame confluence, it becomes a prime continuation area aligned with the smart money flow. Rule number 2: the expansion move should avoid triggering opposite liquidity. This is a critical filter when confirming a valid setup. A strong mitigation block must be followed by a clear and decisive expansion move, but here's the catch: that move should not sweep liquidity in the reverse direction. In a bearish setup, the expansion leg must not break above and clear buy-side liquidity. Why is that important? Because if smart money has already swept that liquidity during expansion, it's a sign they've collected what they need and likely won't revisit that zone to mitigate. The same logic flips for bullish setups. The expansion leg must avoid clearing sell-side liquidity before the true shift unfolds. Rule number 3: the body of a candle must close clearly past the mitigation block. A mitigation block doesn't become valid just because it shows up on your screen. It only gets confirmed when price follows through with a solid body close beyond its range. We're not validating setups based on a wick tap. That's not confirmation, that's indecision. If price simply pierces the block with a wick and then the candle body closes back inside, that's not a valid breakout. It's a trap or liquidity sweep. You need a strong candle body to push and close through the block's boundary. No wick, only breakouts, no guessing games. Wait for clear candle body closure. Let the structure prove its strength before considering entries. Rule number 4: price won't always respect just the wick. Remember that price action doesn't always bounce exactly from the wick area. It can also react from the candle body or the middle point of the mitigation block. That's because institutional order flow is rarely placed at a single precise level. Their orders are often spread across a broader price range, so price might respond to the wick, the full candle body, or the equilibrium zone. Equilibrium here refers to the midpoint of the entire mitigation block. Understanding this helps you avoid missing valid reactions just because they didn't hit the tip of the wick. Rule number 5: the mitigation block must remain untouched. This rule is straightforward but incredibly important. For a mitigation block to qualify as valid and high probability, it needs to remain unmitigated. That means price hasn't come back to the zone yet. Not even slightly. It hasn't tapped it, tested it, or partially filled it in any way. Think of mitigation blocks as single-use tools. Just like order blocks or fair value gaps, once price revisits and interacts with that area, the smart money goal has already been achieved and the potential for fresh entries at that level is no longer favorable. So here's the bottom line: if price has already reacted to the mitigation block, even by a few pips, avoid using it again. Seek new, untouched blocks if you want to increase your chances of high probability setups. We've now broken down the strategy, the key principles, and the institutional mindset behind mitigation blocks, but knowing the theory isn't enough to succeed. Let's walk through some real trade examples and see how mitigation blocks work in actual execution to lock in what we've learned. Here we have the Nasdaq 1-hour chart displayed on the screen. As you can see, the overall market context is bullish, evidenced by multiple bullish breaks of structure. Now, zooming into this sharp bullish expansion, you'll notice that price created a bullish break of structure by breaking and closing above this key swing high. This strong move upward left behind an unmitigated demand zone at the extreme, formed by this large red candle. Given this setup, we anticipate that price will pull back into this fresh demand zone, where we expect a rejection and a continuation of the bullish trend. Once the price taps into the unmitigated extreme demand area, I shift to a lower time frame for a more refined entry and to confirm the reversal structure. Typically, I drop down to the 5-minute time frame at this point to closely monitor price action within the 1-hour demand zone. I'm looking for a clear market structure shift, MSS, as confirmation, and I also want to see a valid entry model form to justify going long. In this case, we can see price has indeed created a market structure shift along with a PD array, specifically, a mitigation block. We have a swing low, followed by a swing high, then a higher low, and immediately, a bullish reversal with strong displacement. This is not a breaker block. Why? Because in a breaker, we expect to see a lower low form before the reversal. Here, we have a higher low, which confirms this as a mitigation block. These 3 consecutive up-close candles represent the 5-minute PD array, the mitigation block. I set my entry at the highest point of the mitigation block and place my stop loss just below the swing low. For my take profit, TP, I'm targeting the nearest buy-side liquidity, which in this case is the swing high on this time frame. Let's play out the trade. As you can see, my long position gets triggered, and price eventually reaches the target. That's it, traders, clean, technical, and to the point. Thanks for watching. Catch you in the next setup. I hope you found this video valuable. If you did, make sure to hit that subscribe button and turn on notifications so you never miss future updates. Down finger, drop a comment below with your thoughts or any topics you'd like me to cover next. Your support truly means the world. Thanks for watching. See you in the next video.